Hey there, everyone. Thanks for joining us for our second webinar. We're excited to get started in a bit, but we thank you all just for joining us. In Georgia, it's a little snowy over here, so we're still adjusting. But I'm Reba. I'm going to pass it on over to Alex, where she'll be directing the webinar more than anything.
All right. Hi, everyone. I'm Alex. And let me go ahead and share my screen so that everyone can see the content. But I'm Alex. I am the CEO of Good Agriculture. We are a small business that helps farmers with everything else that goes in running a farm. So you guys are the experts on the farming, and we like to help folks with all the back office stuff. So today we're going to be talking about financial management, but we also help farmers with finding and applying to grants and with marketing as well. So yeah, that is a little bit about us, and I will hand it over to Alan to introduce himself while my screen gets pulled up here.
Hey everybody, thank you for joining. My name is Alan. I'm the farm finance lead, and yeah, I do a lot of the day-to-day monthly bookkeeping, cash flow projections, and that kind of stuff at Good Agriculture, and just try to take care of our farmers. And I'm excited to be a part of this webinar today.
And I'll jump in.
Oh yeah, go ahead, Reba.
So I'm Reba. I am the marketing lead for Good Agriculture. So we help farmers when it comes to just increasing visibility. So if you need your website done, managing social media, or anything in between to get those customers going, I would help out with that.
Awesome. So some ground rules for this webinar. So first off, feel free to interrupt us with questions along the way. We will have time for Q&A at the end, but again, don't feel like you need to wait until the end to ask questions. So I'm sharing my screen, so I can't necessarily see hands raised or questions in the chat very much, but Alan and Reba are going to help me monitor that. So feel free to raise your hands, come off mute, put the question in the chat, whatever's easiest. Also, feel free to ask specific questions from your farm. I feel like sharing examples with this kind of complex stuff can be really helpful. And so, feel free to give some real life examples that everyone can learn from. The third thing is we are covering some like pretty in-depth stuff, especially in this webinar. So there's really no such thing as a dumb question. Feel free to ask us to define a term or give an example or re-explain something. We are here to help you. And yeah, be engaged. Feel free, like I said, to, raise your hand, put questions in the chat, put comments, um, any of that kind of stuff. That's really helpful to help everyone learn here. So as an icebreaker and also kind of as a way to test the chat functionality, we're going to do an icebreaker. So if you had $1 million, but you had to spend it all in 24 hours, what would you do? Alan, Reba, do you guys want to share your answers to icebreak the icebreaker?
I'm still thinking, actually.
Okay. I'll jump in. You're the financial guru, Alan, so I'm just going to try it. If I had $1 million, I would acquire a lot of land, just a lot of land, real estate, just do it. And then I'll figure out what to grow later.
Yeah, I feel so for everyone on the call, I am not a farmer. I have a total black thumb. I kill everything I try to grow. But I feel like going out and buying something where it was like pretty turnkey and I didn't have to figure out how to operate it from day one, like timber. I feel like that's what I would do. It's like kind of an investment. Don't have to figure out how to like deal with the trees immediately. They'll be fine for a few days while I figure that out.
Yeah, my answer is real estate related too. I would just do all the improvements possible on my house.
I like that.
I don't know if I'd
Unlimited
use up
budget.
the whole 1 million, but well, you never know these days, this economy.
Right.
I mean, if you were trying to like rush home renovate, I feel like that might be $1 million.
So we have a response in the chat. Andy said she'd invest it immediately so that way she can use it later across a longer period of time. Okay.
We found the most financially savvy person on the webinar.
And others seem to be chatting a bit. They're typing up.
Is anyone having trouble with the chat functionality?
Okay, so we got another response. So Arlana said she'd buy 8 acres. Um, and then she would buy a lot of things. And then solar fences, solar fencing, solar panels, a couple of staff, and put farm and school in an ag school on 4 to 5
That's cool.
acres. There would be some sheep, small livestock, and crops. She really thought about this.
Yeah,
I appreciate that.
got a full-on business plan in the chat here.
Yeah, for sure. And Amy also just said that she would get more land. Ben said he would get a lot of fancy ketchups, and like Dijon ketchup. Robin said she would definitely invest it all, and don't have time to think about the decision. Rose said I'd have the best greenhouse ever, glass windows. And then someone else said, pay off the remainder of my loan. I would put 2 new greenhouses and a pole barn for my livestock operation.
Nice.
Some good
Good
answers.
answers. All right. So, for those of you who were not able to attend the first webinar, this is the second in a 3-part series. So, in the first webinar, we covered bookkeeping and like, managing your finances 101. And so this is kind of like the 201 course. So I'm going to give like a quick overview of the things we covered in the first one. If you guys haven't seen it yet, Reba, can you put the link to access the first webinar in the chat for folks? So feel free to go back and see this one if it's just like, hey, I'm a little bit newer to all this, like where should I start? We really recommend starting with the stuff in the first webinar. Because really like what you do on the bookkeeping side allows you to do all the financial analysis we're going to talk about in this webinar. And then the third webinar is going to cover everyone's favorite topic, which is taxes. So we may cover like some things that relate to taxes a little bit in this one, but feel free to save those questions for the next one when we'll really get into this. All right, so what we covered in the last webinar, so we talked about like how to actually track your finances, so using paper ledgers versus spreadsheets versus actual like software accounting tools like QuickBooks or Xero. We talked about how to actually organize your financial data. We talked about a bookkeeping concept called chart of accounts, which is basically like where do all the transactions go? So there's revenue, which is money coming in, so sales, but it can also be things like if you get paid for services or if you have like rental income or grant income. We talked about expenses. The 2 main categories are COGS and operating expenses. We'll get into this a little bit more into this webinar. We talked about assets, which is things that add to the value of your farm. So like land, machinery, breeding stock, if you raise livestock. We talked about liabilities, which is basically like things you have to pay later. So like loans, taxes, payroll, etc. And then equity, which is like the value of what you own. And then finally, we cover kind of how to run a good monthly bookkeeping process so that you stay on top of that. So I'm not going to linger on this one too much and do want to get into what we're actually going to cover today, which built on that. So we're going to kind of frame this as like the things that all farmers should know about their financial situation. So your overall farm profitability and kind of breaking down that farm profitability into what's making and losing you money, figuring out money in the bank and are you going to have enough money in the bank to keep your business operating, how to do budget and business planning, and then how to make sure your farm is actually building wealth for you and your family. Then we will share some additional resources at the end. One thing Reba is going to ask me to plug here is this webinar is really designed to help you guys, DIY. But if you go through this and you're like, whoa, I do not want to do this. Can you guys do it for me? We are running a New Year's special for the month of January. So for folks who want help just getting their books in order or onboarding to one of our monthly services, we're offering $200 off for folks who sign up in January. So you can go to that QR code or just goodagriculture.com/New Year or reach out to Alan, Reba, or me at the end of this, and we will get you hooked up with that. All right, so let's get into the content. So again, we're going to put some notes in the chat here. What are y'all's goals for this session? So we listed out a few here. So feel free to say like, my goal is number 1, my goal is all 6 of these. My goal is something else. The something else is, XYZ. So would love to hear what y'all's goals are for the session so we can make sure we cover everything adequately.
Okay, so Amy answered 3.
Nice. That's a very important one.
Yeah, Rose had a combination of 3 and 4.
Okay.
Helena had 5. Melissa
Nice.
had 2 and 5. Then
Okay.
Andy said 1 through 4.
Got some diverse answers here.
Yeah.
No something else so far?
Okay, we got a 6. Marina, can you tell us what that something else is?
Hopefully it's not how to get $1 million to spend in 24 hours, because we can't help with that one.
Arlana said 1 through 4, and
Okay.
Andrea said 1 and 4.
Nice. I don't think we've ever done this and had each of the 5 answers get picked at least once.
Right.
Any other answers coming through?
Not yet. Oh,
Right.
just trying to gain some knowledge. That was number
Okay.
6.
Nice. All right. So the first thing we're going to cover about every farmer should know about their finances is, are you making money? So what we did is we took one of our business partners, Kirsten, she is a farmer, so she very kindly donated her farm's financial data. This is not real financial data. We edited it a little bit, but this is very representative of a typical farm. So this farm, does it look profitable? And that's important for a couple of reasons. So one, you want to know, is your farm business actually making money? But 2, you want to make sure you have a really good understanding of profitability, because if you are profitable, you have to pay taxes on it. If so you want to make sure that you're fully capturing everything. So does anyone see anything that might be missing on this, profit and loss for a farm? So the reason why we use this example is our business partner is very typical of a farmer, in that she's a great farmer and she loves working with like farm data and soil analysis and all that stuff, but she hates doing her finances. And so what she did every year before we started working together was she would just print out her bank statements at the end of the year, like take all the money that was coming in, take out all the money that was going out, and say like, here's my net profitability. And what ended up happening was she ended up paying taxes because there was stuff that was missing. And so, hang on, there we go. So there's a few things that were missing in here. And this is part of why running a good bookkeeping process is important. So again, if you haven't seen the first webinar, and looks like we have a question from Veronica.
Yeah. Go ahead, Veronica, or feel free to drop it in the chat. And while Veronica is possibly unmuting or typing in the chat, to answer your question, Alex, Andy said that assets and liabilities could be what was missing.
Yep.
Arlana said other revenue, in parentheses, enterprises and grant funding. And then Helena said depreciation.
Yes, you guys actually crushed it. So that on the assets and liability side, so we'll get into, like how assets and liabilities show up on the profit and loss statement or the income statement versus other financial statements. But interest on loans is a very important thing. And we see this all the time where farms look like they are super profitable. And then we're like, hey, do you have a farm mortgage? Because we don't see that on there. And they're like, oh, yeah, but I live on the farm. So it like goes through my personal accounts. And then we pull the interest on there like, oh my gosh, like this farm is not making any money at all. Similarly on depreciation. So depreciation is a funny word for like the value of your assets that show up on the profit and loss sheet. And yeah, when you add in this farmer's tractor and her deer fencing and her greenhouse and all that other kind of typical stuff, and And then also this farmer drives around a lot for her farm because she's going to farmers markets and whatnot. And so vehicle mileage is another important one that she wasn't tracking. So when you all add all this together, you have that this farmer is not profitable. So one question I'm going to ask you guys in a minute is, what are some ideas you guys have for this farmer to improve her profitability? But while y'all are thinking, I'm going to go through and kind of explain this depreciation thing. So there are some things that are money going out of your account. So like I bought a new tractor, and this kind of ties into taxes, but it also kind of ties into the profit and loss, because generally you don't buy a tractor every year. Generally you buy one once every 5, 10, 15 years, and you use it for a long time. And so to capture that on your profit and loss statement, the way we do that in accounting is we say, we're going to take the useful life of that item and take the amount you paid for it, divide it by the number of years it's useful for, and like put that on the balance sheet each time, or sorry, on the profit and loss statement each time. So like if you have a tractor that's $10,000 and you think you're going to use it for 10 years, you would put, $1,000 on that depreciation line. So, some things that count as expenses versus capital, and it's just helpful to know like which bucket to put stuff in. So capital is generally when you buy machinery, equipment, vehicles, whereas an expense would be repairing that. If your tractor needs a fix or your car needs some new tires or something like that, that would be an expense. So you would put that as just a normal expense on your profit and loss. But if you're buying a new vehicle, you would need to count that as capital and depreciate it based off the number of years. Infrastructure is another one where when you build or improve the infrastructure, so you're building a new greenhouse, you're adding like a big extension to your greenhouse, or like you're building a new section of fence or something like that, that counts as capital. But if you just need to repair those things or maintain it, like, I need to paint the fence or whatever, that would be a normal expense. If you have livestock, so any breeding stock you have that are going to be around for more than a year or so would be capital. So like, heifers, sows, things like that would be breeding stock, but something like, a laying hen would probably not be capital because they don't live as long. Whereas expenses, so like if you get some stockers or broilers where you're planning on having them for less than a season, feeding them over the course of the season, then processing and selling, that would be an expense. The other one is around seeds. So like if you have fruit or nut trees, like those obviously take many years to grow and then they're productive for many years. So those are capital. But if you just buy like vegetable seeds, those are expenses. And so the rule of thumb we use, if it's less than $2,500, you can expense it and basically like remove that tax liability as quickly as possible. But if it's more than $2,500, you should see if it's capital. So, either Google it or ask us or ask a CPA, like, hey, is this capital? Do I need to depreciate this? Any other like examples you guys want to ask about is like, hey, is this capital or is this an expense? Any
Hey,
questions we got in the
Reba.
chat?
Hey, I'm sorry, this is Veronica. I was just raising my hand because I can't comment in the chat. I can't do anything. It's like I'm blocked.
Okay, thanks for letting us know, Veronica.
That's the
Do
only
you
question I
have?
had.
Oh, okay. We'll try to figure that
Thanks.
out.
Yeah, maybe Reba can figure out something with the settings in the background here. Okay.
And Andy had a question.
Yes.
Vehicles count as?
Yes. Vehicles count as capital. Now, again, we'll get into this a little bit more in the tax webinar. Because with the vehicles, you have two options. So this farmer chose to take mileage, gasoline, etc., as like separate expenses versus taking like, or sorry, I take it back. There's two ways you can do vehicles. You can either just depreciate the vehicle, or you can take all the vehicle expenses. So, the fuel, the repairs, et cetera, et cetera. And generally, if you have a newer vehicle, it's better just to take the depreciation and all the expenses versus if you have an older vehicle, the depreciation is not worth as much because the vehicle's not worth as much and it's better to do mileage, but you're only allowed to pick one. So Yeah, vehicles are one where it's just like super confusing because you have multiple options. But buying a vehicle would be a piece of capital. You would want to add it to your balance sheet, your list of assets, and then you would want to depreciate it generally. But again, this is like a ask your CPA for like the most optimal way to do this one. So okay, so what ideas do you guys have for? Oh, go ahead, Reba.
I'm
Sorry.
gonna jump in real quick. Andy asked, unless it's a loan, right? It's on a loan, right?
So yes, but the you would really do both. So if you buy a vehicle, so let's say let's take it, you just buy it with cash right now. Um, so you say, I now have this asset, which is a vehicle, but now I have $30,000 less cash. So that actually, let me just jump ahead to the example balance sheet because I can show you where all this goes here. Jumping way to the end here. Okay. So when you buy a vehicle, it would show up on your assets list. So you can see on this example farm, we have equipment and vehicles under that intermediate assets. So that's where you would put the value of the vehicle. And then if you finance the vehicle, you would put that under liabilities because now you might have, and there's no vehicle loan line here in this example, but like this farmer would have a vehicle loan. So you might say, I bought a vehicle that's worth $20,000, I would put that under assets. And then maybe I had to finance $15,000 worth. So I'm going to put that $15,000 loan under liabilities here. And then each month, as you pay down some of that principal, so like I made a $1,000 payment on my vehicle, 500 of it went to principal. So I get to take that $15,000 vehicle liability here and subtract 500 because now I owe $500 left on the loan. And you do that every month until the loan is paid off, and then that disappears on your liabilities, but you still have the asset. Maybe the vehicle is worth less now because you had to depreciate it some, but it's still there on the asset side. And so that's how you end up building equity, because equity is assets minus liability. So you still have this vehicle, but you paid off the loan, so that's now zero. So that difference is now in your pocket as like wealth for the farm. Alan, anything you would want to add about kind of how to handle like what happens when you buy an asset?
No, I mean, I think you covered it well by showing this example here.
We do have an additional question, or yeah, we have an additional question from Amy. So Amy says, I have a vehicle that is used for personal and farm use. I track my farm mileage and just deduct that. We do not have a
Perfect.
loan on it. Is that the correct way to expense vehicle expenses? It is 11 years old.
Yes, that would be that is probably the easiest way to do it if you have a joint personal and farm vehicles. Just track your farm mileage and then stick that. I'm sorry, so I have to scroll way back to our income statement. God, who made all these slides? And stick it in there in mileage. And so that's part of why Kirsten, who's our business partner, like that's part of why she does mileage one, because it's an older vehicle, so that just makes more sense. She gets a larger deduction that way, but also she drives the vehicle for the farm, but then she also drives it for like when she comes to work at Good Agriculture, and so it's a mixed use vehicle, and so tracking that farm mileage is exactly what you want to do. As far as tracking mileage, there's a few different ways to do it. So you can just kind of like estimate at the end of the month and like put in whatever your best guess is. Some people like to have just like a little notepad in the vehicle, and they can just like jot down every time they use the car for farm purposes. There's also like apps that will track this, where you can just like push a button every time you start a farm trip and it'll track the exact mileage. So just find a method that works for you. Any other questions related to vehicles? We just went straight for like the most complicated part of all of this. So good job, guys. We said
No
this
new
was going to be
questions
the
yet.
advanced stuff, and that's exactly where we went. All
And
right.
no new questions yet, so go for it.
Yeah. So the question I had for you guys was, so looking at this farmer situation, so her farm is unprofitable. What ideas do you guys have for how to get her farm more profitable? Or what additional data would you like to see to be able to answer that question?
And while they are typing in the chat, we did get an additional question when it comes to the vehicle.
All right.
So Andy asked, what if you don't do mileage and instead just pay for the gasoline? It's a farm vehicle only.
Yeah, so then so again, you have two options. You can either do the expenses or you can do the mileage. And so if you do expenses, that means you just, use the farm credit card every time you pay for gas, you need maintenance, any of that kind of stuff, and you would just do it that way. So what mileage is basically the IRS saying tracking all the vehicle expenses is really complicated. Like, the average vehicle needs 67 cents worth of gas and maintenance and new tires and all this stuff, like for every mile you drive. So just have 67 cents per mile, and we'll just make it simpler. So again, you can pick mileage or you can pick tracking expenses, but you have to do one of the two.
And you can track both at the same time, right? It's just a matter of
Yeah.
when you file your taxes, that's when you have to choose. But
Yes.
it doesn't hurt to do both throughout the year and then kind of compare what will benefit you the most in terms of tax liability.
Yeah. Yeah. Thanks for catching that on. Yes, you can track both, but you can only count one.
Good stuff. And I'm going to go to Robin's question and then we'll go back to Arlana.
All right.
So if you lease a vehicle, can the payment be a direct expense on the P&L if it's primarily used for the farm?
Yes. So if you're leasing any equipment, that would go. So that this profit and loss statement doesn't happen to have like any kind of rentals on here, but vehicle rentals, equipment rentals. Some people have even like rented livestock. Like if you're, renting a bull, for a season, like you would put that all under expenses. Yes.
Okay.
Or if you're
And
renting land rent, that's the kind of the most obvious one that I missed. Sorry, guys. That one would also go under expenses.
good stuff.
Yeah, that's a good
Arlana
question.
asked, what farm operations does she conduct before she answers your question? And then the other question was, and what market does she sell to?
Yeah, great question. So you just led us exactly into the second thing every farmer should know about their finances. I promise we didn't plant them. So basically we want to be able to break down profitability, kind of see what's going on, because it's good to know your overall number, but like this doesn't really tell you that much of what's going on. So we took this farmer and she has 3 different enterprises. So she grows strawberries and she sells those strawberries, 1 at the farmer's market, and 2, she does like a U-pick operation. And then 3, she just has like regular market garden vegetables. So she'll grow lots of different seasonal vegetables and sell them at the farmer's market. And so, we call this profitability by enterprise. So like actually taking your different enterprises and building the profit and loss statement for each so you can really kind of see what's going on in these different enterprises. And, first off, I'm curious what ideas you have for this farm, kind of seeing this breakdown. But I also want to go over a couple more terms here. So the first is this profit and loss statement, what's actually going on here? So the top line is revenue. That's kind of what it is. Just like she sold this stuff and here's how much she sold of each of these things. And then we get to the 3 different types of profitability you see on here. So there's gross profit, operating profit, and net profit. So gross profit is basically my profit after taking into account what I had to put into the thing I sold. So if we take the strawberries, for example, so the farmer has to pay for the strawberry seeds. She buys a bunch of like compost and some different soil amendments for the strawberries. And then she has to like put them in nice little plastic boxes to take them to the market. So that's kind of all the things she needs in order to like produce the strawberries that she's actually going to sell. And so why gross profit is important is because this number the percentage here should be well above 0. If your gross profit is ever negative, that is like a 5-alarm fire, like, because it basically means the more you produce of that thing, the more money you are losing. And so that is a really bad position to be in. So again, if you ever see gross profit less than 0, that's really bad. Take action immediately. So then the next type of profit is operating profit, which is basically how much profit do you make after taking into account all of the expenses it takes to keep the farm running. So you can see you add in the farmer's labor, her vehicle mileage, going back to the mileage, like her tractor fuel, supplies, et cetera, et cetera, et cetera. And so you can see operating profit. And again, obviously you want this to be more than 0, but if it's less than 0, there could be a few things there. It can mean you're just not selling enough of something. It could mean your farm expenses are too high. There's a lot of different things that could be happening here. And actually, in some situations, it's especially when farms are just starting up, it's normal for operating profit to be negative at first. But obviously, this is not a sustainable situation to be in. And then net profit is basically what you do once you also take out like interest on your loans, depreciating your equipment, any taxes you have to pay, et cetera, et cetera, et cetera. So those are the 3 kinds of profit here. So yeah, so now that you kind of like see this, like any ideas you guys have for this farmer, what would you do if you were her?
I think they're still thinking about it.
And maybe while folks are dropping some ideas in the chat, also kind of want to just like talk a little bit more about the cost of goods sold and operating cost, which you guys can see here. So cost of goods sold is the cost you take out of revenue to get to gross profit. And then the operating expenses, we call them farm expenses here, but it's basically, all the ongoing farm things that you subtract from gross profit to get to your operating profit. But these people use a lot of different terms for like kind of the same thing. So sometimes people call cost of goods sold direct costs because they go directly into whatever you're producing. Sometimes people call them variable costs because, if you produce more or less, you will tend to have more or less of cost of goods sold. So like if you are growing a lot more vegetables, your cost for the vegetable seeds is going to go up with the number of vegetables that you're planning on growing. And then on the operating cost side, and this kind of like what do you need to keep the overall farm business running? Sometimes this is called overhead costs or indirect costs because it's like indirectly what you need for the business. Sometimes it's called fixed costs because like your farm mortgage, for example, like that is the same cost no matter how much you're producing because like you just have this land and you have a 10-year mortgage on it or whatever. We like to use the words COGS and operating cost because like and mostly it's just we don't like fixed and variable costs because like farms compared to other businesses, like the COGS are not as variable as in some other businesses. So like if you're running a factory, you can just say like, okay, well, today I don't want to produce anything. I'm just going to turn the factory off. But like if you have a farm or like if you have livestock, for example, you can't just say like, oh, like I don't want to sell any livestock today. I'm just going to like, turn off the like hay supply. You can't do that. And similarly on the operating cost side, there are things like, the farm utilities or, whatnot that might actually like fluctuate a little bit with, how much you're producing. So we think that like fixed and variable is a little bit confusing. And so we like COGS and operating cost instead. But just know that there are other terms out there. So if you see other resources that call them different things, just know it's kind of the same thing. And basically the idea is you just want to know like what things go directly into what you're producing, which are those COGS versus, what are kind of like just the general farm business expenses, which are operating costs.
Answer.
Alan, anything you want to add to that?
No, I think that's great. Yeah, and just maybe emphasizing that it can be confusing when you hear different terms thrown around. But yeah, those are the 2 main points of emphasis. Just what went into the actual thing you sold versus what are these kind of more general expenses that don't necessarily fluctuate as much, but sometimes it can. Yeah. So maybe just choose. Maybe that's another little tip is like just choose language when you're doing your books, and then like just stick to that.
Yeah, just come up with a system that works for you is really the key thing.
Yeah.
Reba, did folks have ideas in the chat for our farmer here?
And Robin said more you pick market.
Yeah.
Laura said reconsider doing markets.
Reba,
Melissa
Alan
added on. Go for
Alan,
it.
is Reba breaking up a little bit for you?
Yeah, she did break up a little bit. I can read these comments real
Okay.
quick, and while her connection comes back. But yeah, so you heard the first one. More you pick, less market was one answer.
Mm-hmm. Mm-hmm. Yeah, I
Laurie
mean
says,
it's remarkable how much more profitable UPick is than everything else. And this is something we see very commonly with farms, especially is like, you know, you look at everything lumped together and it's like, well, this farm is basically breaking even. But then you break it out and it's like, whoa, something is really profitable and these other things are really unprofitable, and then it gives the farmer some good decisions of like, well, is it even worth doing the markets anymore if I'm losing money
right.
on them?
And that's what Laurie said.
Yeah.
Yeah, and this is an
Sorry, Lori, I didn't mean to
interesting
steal your-
example. This is an interesting example too, just because even though we don't have a breakdown of the revenue line, I'm sure that if you were to do, and I think we're going to get to this later in the slides, but if you were to do like a unit profitability analysis, you would see a lot more profit, per pound of strawberries because oftentimes people are buying this like flat fee to just get into the farm. It becomes more of an experience, and people are more willing to pay. So I guess for this operation, it's like, hey, that's pretty insightful to see those
Mhm.
those major differences in profitability.
Mhm. Yeah, and I'm glad and one question we get sometimes is like, okay, cool, like this profitability by enterprise thing is great. How do I actually split up all these costs into these buckets? So there's a few different ways you can do this. And so the first method is, the easiest one, which is like each expense, just tag it to a specific enterprise. So this is especially really easy on the revenue side because it's like, okay, the strawberries I sold at UPick today, those obviously go into the UPick category. The vegetables I sold at the market obviously go into the market vegetable category. But this actually works for a lot of cogs. So you can imagine like, especially for this farmer, we're talking about strawberries versus vegetables, like, the strawberry seeds go in one bucket, the vegetable seeds go into another. And then like, the packaging for the market vegetables go into that bucket and like the little baskets that you hand people for UPick, like those go into the UPick category. So that's kind of the easiest where you tag the expense, you put it in a bucket and it just goes there. But there are a lot of expenses where it's like, okay, I don't know specifically which one this went for. So there's a couple different ways you can allocate things and split it out. So one is allocating by volume. And so this is, I'm going to take this expense and put a percentage of it in each enterprise based off of like how much I used for each enterprise. So this works well for some of those COGS expenses. So, for example, if you buy compost like this farmer does and uses the compost for her vegetables and for her strawberries, she might say, okay, I used 60% of it for the strawberries and 40% for the vegetables. So I'm going to take 60% of that expense and put it with strawberries, 40% and put it with the vegetables. But again, you may think like, okay, well, there's still a lot of expenses where I don't know how much of it went to what. And so for those kinds of things, what we do is we like to allocate by revenue. And so we say, so let's take like the farm's power bill. Like we don't really know how much of the power bill went into the strawberries versus the vegetables, but what we can do is say like, okay, the strawberries here were like 2/3 of the total revenue. So I'm going to put like 2/3 of the power bill on the strawberries and like 1/3 onto the market garden vegetables. So that's, one way you can do it. And so one thing that I don't think we've said yet is we do have templates for all of this stuff. And so the templates can help you kind of just like break this out automatically. So if you would like a like Excel template to do this for you, just email us and we will send it to you and we'll kind of like do the allocation by revenue automatically for you. If for like especially these general farm expenses, that's not easy to allocate to a specific enterprise. Any questions on that?
Before you continue, Andy had an interesting question, which is, are tools and equipment considered a variable cost?
Yeah, so this is Andy, that is exactly why we don't really like the variable cost thing, because tools and equipment, it is something that like the more you produce, the more of those things you're going to need. But, if you're like, let's say you're raising laying hens, so it's eggs. It's like to produce one more egg, you do not need like, one more unit of tools and equipment. And so we wouldn't put that under COGS, but it is kind of a variable cost. But like people call, operating cost fixed cost. So you see why like that's a really good example of like it just doesn't quite work for farms. So we generally put tools and equipment in operating costs. So like there's this general supplies bucket under the farm expenses. That's just a good catch-all for all of this stuff. And generally, again, the more you produce, the higher this category is going to be. But it's not super directly, to produce one more egg or like one more pound of strawberries or et cetera, I need like this many more tools. But it's like once the farm hits like certain thresholds, I will obviously need more. Or like the more I use this thing, the more it'll break and the more I need to replace it. So yeah, that's why picking a system that makes sense to you is important here, because we do have some folks who are like, oh, well, like this kind of supplies I would put in COGS, and then they do that and it makes sense to them, so it works. Yeah, so that's again, it's complicated. Andy's got these good questions. And were there any other questions on like the profitability by enterprise piece?
Well, let's see. One question just came in. It's a little long. Let me just read it, I guess. Well, it says off-topic question. Let's see how off-topic it actually is. But just curious why some farmers or people that have livestock say they don't see much profit from what they're doing. I know many struggle, and like any other business, we have highs and lows, but is it more of them not managing their business properly or what? I would love to start a farm business, but would like to learn more before starting. Yeah, no, that's a loaded question. That's like a webinar in and of itself.
Yeah.
But a
Yeah.
really good question.
And honestly, so we work with a lot of livestock farmers and we've seen every flavor of this. So we worked with folks who like just weren't charging enough for what they were producing, and so their revenues just weren't high enough to cover the cost. We have seen people where just like the operating costs were just really high, like they were spending way more money than they should have on like insurance or fuel or something. And it was just like, whoa, this is really out of whack. And like if they were able to like cost control a little bit, then that was what it was. We've worked with some farmers where actually it's just like a like land rent and or the mortgage insurance, and like this like their operating profit looked good, but as soon as you added in this mortgage interest, then like the whole thing got so upside down really quick. So, and I think this is not just for livestock farmers, I think this is for all kinds of farmers, is like it's very easy to be unprofitable, and so being on top of this stuff is really important. And there are very few folks we have seen who just manage to like skate by and be profitable without looking at these numbers frequently. And those folks tend to have such amazing business models that it works. So like again, like doing just you pick can be a really good business model because you can charge a lot and your labor costs are really low. And but you have to be like a really good marketer to pull that off. Or there are folks who have just like really deep relationships with lots of restaurants, and again, they get a good price for what they have. And so their revenues are high. And so, they can pull off not looking at this and just being profitable anyways. But for most farmers, this is very important because there's a million different ways to not be profitable. Alan, I don't know if there's anything you would add, because I know you've done a lot of these, like especially like cattle business cases.
Um, well, I guess the only quick thing is just, well, yeah, I mean, it is, yeah, it's pretty intense, especially just considering the macroeconomic factors that sometimes are outside of your control that can make things really hard to be profitable. And like, I guess, like livestock in general, especially, you're dealing with, you're going to get revenue several months later, just because you got to grow the animal and everything. And so, obviously, it depends on what kind of livestock you're going for. Uh, but like with, if you're trying to do beef, for example, you could imagine a world where if you had a bunch of upfront capital to like really start a herd and manage like pasture really well, that like maybe upfront there's tons of money that goes into it, but like in 10 years, you could have like this really profitable operation, but like it would probably be 10 years of pain until you get there. So yeah, I guess it takes also a certain type of personality to really get into that business. Not to scare anybody or anything, but
Yeah. Um, yeah, I think Alan, you also mentioned unit profitability, and so this can be a helpful analysis to do as well, especially if you are thinking about starting a business. Um, And what can be helpful here is, so we'll give two examples. So one is if you are doing something that's like a per acre, so like row crops, and you're kind of trying to figure out like, okay, like how much should I plant, and how much is this going to cost, and what's going to be my profit at the end. And so we gave two scenarios here. So one is a like, okay, I'm going to invest more into fertilizer and inputs and seed coatings and all this good stuff, and I'm going to get more yield, versus, okay, I'm going to spend less on this stuff and I'm going to get less yield. What happens? Um, and so you can see here the on the left, the farmer gets higher yield. They get 150 bushels per acre, but they're spending so much more on fertilizer that their profit's only 150, compared to, scenario two, they only get 100 bushels an acre, but they spend so much less on fertilizer that they actually are more profitable per acre. And so this is one example of how breaking down unit profitability can be helpful. And then another example of so a beef. So someone who raises beef and sells it, direct to customer. So in scenario one, this farmer's only making $100 per head of cattle. So like let's say, they sell their beef for $6 a pound. When they get the beef back from the processing plants, they get 600 pounds of, steaks and roast and ground beef and stuff that they can sell. So $600 that they can put into the inventory. So the revenue per head of cattle is $3,600. And then you take out, it's $1,200 to buy the cow at the beginning of the year, $1,000 to feed it. I had to spend like $100 on supplements and vet care and whatnot. And then I had to like truck it to the processing plant and process it. So it cost me $3,500 a head. So I only got $100 per head. And so the farmer might run a couple scenarios like, okay, what if I can get, more per pound so I can raise my prices? Well, suddenly now this farmer's making $1,300 a head. The farmer might also say like, okay, well, what if I can sell more of the cow? What if like I can sell the organs or the skin for leather, or the hooves, or like some combination of those things? Now I have like $700 worth of stuff to sell instead of six. And again, they can now get $700 per head of cattle. Um, and where this can be helpful, especially in like planning for a new business, is you can calculate your break-even profitability, which is basically how much do I need to sell for the whole farm to break even, basically to be at zero profitability, not be unprofitable. So basically what you do is, and here's the example with the row crops again. So, scenario one, the uh, the farmer is making $150 an acre. So let's say this farmer, their operating costs are $24,000, and this is not per acre, this is for the whole farm. So I spend $24,000 on insurance and my tractor and that kind of stuff. And then interest, taxes, and depreciation is, $6,000. So my farm mortgage, interest, and that kind of stuff. So they have $30,000 of costs they need to sell. So $30,000 divided by this $150 per acre means they need to plant 200 acres to break even. And then you can see this in the second scenario where they're making more profit per acre, they need to plant less acres to be break even. So, if they plant 200 acres, that 171 is covering the cost, and then that last 29 acres is just pure profit for them to put in their pocket. And you can see in the beef example, it's even more dramatic. So, if the same farmer has like the $30,000 in cost, I'm sorry, this says acres. This should be head. So in scenario one, they need to raise 300 head of cattle to cover their operating costs. But in the second scenario where they're more profitable, they only need 23. So that's a huge difference. I mean, that's literally, 15x the time as many cattle to break even. So doing this kind of analysis can be helpful to kind of just figure out where you need to be on your farm. So we are running way behind time because of all these good questions. So I'm going to skip the what ideas do you have for this farmer? I'm sure you guys have good ideas, but please keep putting your questions in the chat because this is helpful. So any questions about profit and loss income statements before we move on to cash? All right. And just, I know you guys are probably, only allocated an hour for this. We will keep going through the content and make sure we answer everyone's questions. We'll try to speed up a little bit, but we're going to clearly run over time. We are recording this, so just let us know for the record, and we'll send you the recording afterwards if you have to leave early. Okay, so before we, the next question is are you going to be able to pay your bills? So profitability is nice, but cash in the bank is what you need to pay your bills. And Alan, you have a really good, I don't want to call it a rant, but just some strong feelings about profitability versus cash. Would you like to share that?
Yeah, but I'll do, I guess, a short version. But basically, in a nutshell, when you see that line net profit there at the bottom, that is not always, sometimes it is, but not always is that the number that actually moves the bank balance that you see when you open up your bank account or log into your bank's platform, because there's other cash flow activities that happened that are not related to the income statement that you just need to be aware of. So that's the very short version.
Yeah. Yeah. So this question of, is this farmer going to be able to pay her bills? It's a trick question. We do not know just looking at net profit because we need to know what's going on with her cash. How much money does she actually have in the bank? So this is what's called a cash flow statement. And so it starts with the income statement. So you can see the very first line on here is net profit. And so this is broken down into 3 chunks. So the first chunk is cash from operations. So this is running your farm day to day. What is the cash situation? So again, net profit is usually the most important thing on that. But you notice this depreciation line. And so remember, depreciation is not really an expense you had today. So for this farmer, she bought a tractor several years ago and she depreciates a little bit of it every year, but it's not she already paid for the tractor. So the tractor's just hers. So that is cash she gets to add back in to the cash from operation. So it's a bonus that she gets because she's not actually paying that money. Farmers who have a lot of inventory can be a cash suck. So for example, let's say, you, and maybe the easy example here is if you run a CSA and you grow the vegetables and your buddy down the street, has raises beef and produces meat, and you say, hey, friend, I'm going to buy your meat and put it in my CSA boxes and sell it to my customers. Well, if you buy $1,000 worth of meat from the other farmer and you haven't sold it yet, that is negative cash because you've already given the other farmer some of your cash, but the customers haven't given you their cash yet. So that would be something you would subtract out if you do have a lot of inventory. This farmer, because she just does vegetables and strawberries, she doesn't really have an inventory, so it's 0. The second chunk is cash from investments. And so this usually for a farmer means I paid money for something, for an asset. I bought a new vehicle. I bought a new tractor. I bought I bought a piece of land. But if if someone buys a tractor from you or buys maybe you raise you have like a tractor you refurbish and you're selling, like, that would be positive cash from investment. But usually, again, for farmers, generally cash from investments is negative, and this tends to be the one that really like is a suck on people's cash situations. Then the last one is cash from financing. So this is as you pay down principal on your loan. So you pay your farm mortgage, you pay your tractor note, all that stuff. That's money that would be going out. Or on the flip side, if you got a loan that month, then that would be cash coming in because the lender is like, here, farmer, here's some money. And now that's cash in your bank account. So this farmer, when we pulled together her cash flow statement, you can see this is big red cash. She's losing cash even though she's profitable. So this is a very common situation where farms are profitable, but they're cash negative because farms are like very heavy on the infrastructure, equipment, land, all these kind of like investments you have to make. So, what can you do about that? So for this farmer, what we did is like, okay, you're running out of cash. Let's get you an operating loan. So you can see for this farmer, she got a loan in January, and then the payments on the loan start in March. And so you can see it's cash coming in at the beginning and then cash going out in the future months. But this is enough to like keep her closing balance in the green. So she always has some cash in the bank. So, it's very common for farmers to get operating loans every year. And this is why, because you have to buy all of your stuff at the beginning of the year, and you usually don't get paid till the end of the year. Any questions on that?
I'll just quickly add there that when you see the cash going out on the loan side, that's the principal only. The interest portion of it will show up and affect your net profit. It'll show up in the income statement.
Yes, great point, Alan. Okay, so you might say like, okay, this is fine, but like this is last year's cash statement, and like I already paid all these bills successfully, so that's not very helpful. I'm more concerned about what's happening moving forward. That's why budgets are important. So having like a forward-looking budget is really helpful for folks. So this farmer, she's like, okay, clearly the market vegetables are losing money. I kind of have to still do the market strawberries because sometimes people don't pick all the strawberries and I have some left over and I might as well sell them because otherwise it's just, they just rot in the field and then that's bad and I don't want that to happen. But then she might say like, okay, but like I also want to raise rabbits. Let me analyze like what it would look like if I added rabbits this year. So you can see when she, sets this budget up, like rabbits look nicely profitable, like got a gross profit of 38%. They're covering their share of the farm expenses. And so there's a nice profit there. But, when we ask this farmer, like, hey, where's that $80,000 coming from? She's like, oh, well, I'm going to sell my rabbit for $20 a pound. And then at that point, we might say like, whoa, $20 a pound. Like, there's no way you're going to be able to get that. Like, why don't you go talk to some of the other folks in your community and like see how much rabbit is actually going for. So she might come back and say like, oh, just kidding. Rabbits are like $8 a pound. And then when we run this, you can see that like rabbits are actually very unprofitable. So doing this like forward looking budgeting and business planning before you make decisions at the beginning of the season can be really helpful. Just to make sure you're like making the right assumptions about stuff and, that like you're going to put a lot of time and effort into this stuff. So it like might as well be profitable. Now, as far as like where to actually get these numbers from, so we kind of put this in order, of order from like most reliable to least reliable. So the most reliable set of numbers you have is actually your own numbers from last year. So like this farmer, when we put together her budget, we basically said, all right, we're going to take last year's numbers and we're just going to assume all of your inputs are going to get 3% more expensive because of inflation. And so, that's very reliable because it's like, this is how much it cost you last year. It's probably going to cost you something similar this year. But if you don't have last year's numbers, you can actually like get quotes from suppliers. So you can, go to johnnyseeds.com and like see how much are these seeds at. Like if I were going to buy these seeds, how much would they cost? Or if you have like there's a local compost supplier, you could give them a call and say like, hey, how much is compost? If I was going to buy this much 6 months from now, how much is it going to cost? And they'll hopefully they'll tell you. Something that's also pretty reliable is just asking other farmers in your community, like, hey, what did you pay? Because, you know, if they're in your area and they're growing something similar, like it's probably going to be the same price for you. University extension can be really helpful because again, they are in your local community. They, you know, kind of know what people are seeing on the ground. That can be really helpful. Then, you know, if you don't have access to any of those things, there is always the internet. But there's a big asterisk on there of like, just be careful that you know, anything you get off the internet, like that, make sure it's, you know, actually pertinent to like your local community, you know, it's accounting for all the things, etc. So you know, our rule of thumb is like if it's just an internet quote, just like just assume it's going to be like 20% more expensive just to make sure you're being conservative in your budget. And then of course, feel free to ask us some of these questions too, just because we've seen a lot of different farms and can help, you know, gut check stuff like you're not going to get $20 per pound for rabbits. Okay, and then it's also, it can be helpful to plan for one-time expenses. So first off, I realized that this chart is very complex. Alan, do you actually want to walk through this one since this one's your brainchild?
Yeah, so this is just an example of I mean, overall decently straightforward template for doing cash flow projection. So this is forward looking. And so the way that you can do something similar like this is you can take, you know, your historical profit and loss, you know, take your historical cash flow statement, and then come up with a model that allows you to then take those same numbers, adjust them, tweak them to, you know, and you can do this actually, yeah, you should definitely do scenario modeling when you do this. So you could do like a worst case or a best case. So like in the best case, let's say I double growth or I double revenue next year on average or something. And the worst case is I do half of what I did last year. So you can run these different scenarios, but then you can also have these line items for, you know, upcoming expected expenses that you know, want to invest in or something. You can also think, you know, at what point in the future might I need to access funds through a loan or maybe even equity. You know, maybe you need to invest from your own personal funds into this business. And how much would that be? Am I willing to do that? So this is a tool that you can use to kind of help guide some of those questions. Um, yeah, anything else you would add to that, Alex?
Um, no, I don't think so. And you know, just we find this like blue box to be helpful of just like other cash flows. You can just type in numbers of like, you know, I need to pull $2,000 out of the business every month to cover my personal expenses. You know, on line 4, you might for $30,000 be like, oh, mate, I think I'm gonna have to buy a new truck in May potentially. And you can kind of see what that effect is gonna have on your net cash. And if you type in your projected opening balance, you can look at these projected closing balances to make sure that they are all more than 0. So like this farmer in May, when she had that $30,000 expense, it actually made May's projected balance go below 0. So what we did was we added in this $100,000 loan and say, okay, well, what if you get, you know, an operating loan at this point and you do have to like pay it back? But that kept all of her closing balances above 0. So this can kind of help. And so like this farmer, like we ran this for her in January, and so she saw like, oh, in May, you know, I might run out of cash, and so we were able to take action earlier. And so she didn't have to be stressed about it. She's like, okay, I've got 5 whole months to get a loan and like plan for this expense. And so this can just really reduce the headache you have as a farmer.
Yeah, and if you're, you know, inclined to spreadsheets and you're kind of a spreadsheet whiz, you can see how you could really get pretty detailed. This is a very kind of like high level example of doing this kind of thing.
Yeah. And again, we can share the template for this if you guys need it. All right, so we are coming all the way back around to the balance sheet. Is your farm helping you to build wealth? So we kind of went over this. So a balance sheet is basically how much is your farm business worth? And so it starts with assets, which are basically things that are valuable. And there's kind of three buckets of the assets. So current assets is basically things that you could turn into things that either are cash or you could turn into cash pretty quickly. So generally, you know, things that are valuable within less than a year. So your cash in your pocket, livestock you have for sale that are going to be, processed or sold or whatnot within a year, anything in your inventory, and then any crops that you are growing in the ground. So that those would be your current assets. Then intermediate assets are generally things that, are going to be valuable over like a 5 to 7 year time frame. So again, that's usually like equipment, vehicles, machinery, breeding livestock. If you do livestock, that'll be your intermediate assets. And then long-term assets, this is generally like your land and your infrastructure. And so you add all those things up and that's your assets. Then liabilities are like things you will have to pay at some point in the future. So this is, so in the short term, this word payable basically means like the parts of your loans and whatnot that you will have to pay within the next 12 months. And so again, this is the kind of like more advanced way of doing it so that you can make sure that like your current liabilities are not more than your current assets, because if they are, then that might indicate that you're going to be in a little bit of a cash pinch. But, some people say like, I don't really want to mess with this like payable stuff. I'm just going to put my whole operating loan in the intermediate liabilities. But, so this is one way to do it. But this is kind of the more advanced way. So again, these loans payable, this is just the payments you're going to have to make in the next 12 months. And then taxes, like you got to pay taxes every year. So that's there. Then intermediate liabilities, this is stuff you have to pay back kind of like between years 2 and 7. So generally your operating loans and your machinery loans go here. Again, if you take those first 12 months and put them into current liabilities, then you would say, this is whatever the balance of the loan is minus the current liability. Then the long-term liabilities are things you have to pay, like more than 7 years. So again, generally it's your farm mortgage would go here. Minus any like current that you would put in the first bucket. So again, the thing that is important about the balance sheet is assets minus liabilities is owner's equity. So this is a kind of a shorthand for like what your farm is worth. So again, you definitely want this number to be more than 0. But like the higher this number is, the more wealth that represents for you and your family. Any questions about the balance sheet? What things go where? What any of these things mean? Kind of already covered some of this stuff at the beginning. So one thing that can be kind of helpful to know, like, is my balance sheet good? So there are ratios that are out there, and there's like some good farm benchmarks against them to kind of just see like, where does my farm stand? Like, how resilient are my farm finances? And so one of those things is debt to asset ratio. So basically you take your total liabilities, all of your debts, and you divide it by the value of all of your assets, and you get a number. And you can see for this farmer, it's like 81%. Now, a really strong ratio would be 30%. So if I have, $1 million in assets, but only $250,000 in loans, then I'm doing pretty well. Stable. So this means like, you're not like fully out of the woods yet, but your farm can probably, be pretty resilient. You can probably have a few bumps in the road and be okay. That'd be 30 to 70%. And then weak is more than 70%. Now, weak does not necessarily mean bad. And, the balance sheet ratios are going to change a lot as your farm business gets more mature. So when you first start out, it is very normal to be in kind of this weak category. And again, that doesn't mean it's bad. It just means you might be new, or your farm might have gone through some stuff and you're kind of like, building your balance sheet back up. But this means you do kind of have to be pretty careful, on the cash front, and make sure your operations are running profitability and like all that good stuff. So if you're in the weak category, it means just you need to pay more attention. Months of cash on hand. So this is, I take how much cash is in my bank accounts, and then I take like what my normal monthly cash is. So if I, have $13,000, and, normally every month there's like 7 months of cash going out the door, then I would have 2 months of cash on hand. And again, you generally want to be above 1.5. Return on assets. So this is how much profitability am I making based off the assets that I have? So this farmer is unprofitable, which is why that number is negative. So obviously being unprofitable is not good. But just say this was like positive 5.6. So if I have $1 million of assets, I'm making like $50,000 in profit on that, if I'm doing that math right. Not sure if I am. Um, uh, and so, that would, if this was actually 5% and not negative 5%, that would put them in the stable category. So it's just those ratios can just kind of help give you an understanding of like, where am I compared to like the average farm? Any questions about that? All right. So that is the end of the content here. Hopefully we achieved a lot of the goals. So yeah, we'll take some time for questions at the end here, make sure we got everyone's questions answered. While y'all are doing questions, I'm going to give the requisite sales pitch of we do help farmers with this stuff. And so we have a few different financial management packages to be able to kind of like do this stuff for you on a month-to-month basis and just give you the numbers and give you the insight you need to like be able to kind of understand all this stuff without you having to do all the spreadsheet wrangling yourself. So there's kind of 3 tiers. So the first tier is basic. So this is really around just like getting the bookkeeping right, getting those financial statements, and just trying to do it for you guys like as cheap as possible. And we want to make this affordable for all farmers. So this one starts at just $75 a month for small, simple farms. Now, obviously, if your farm is bigger or you have a lot of different enterprises or a lot of stuff going on, like we do charge more, but that is kind of the base price there. Then the essentials package. So this is really, it's the basic bookkeeping, but then we also add in some more like reporting and insights, and we do like the cash projections. We help you with your tax forms, that kind of stuff. And also, you can give us a call and ask us questions when you feel like it. And so that starts at $150 a month again for those small, simple farms and kind of goes up from there. And so this is a really good fit for folks who are like, they're really trying to run their farm like a business. They're really working hard to improve their profitability. And they just really kind of like need a little bit more data than you just get from like basic bookkeeping. And then we also have a premium tier that's really kind of designed for those, those farms who have a little bit more complexity going on. They really need to like rely on numbers a little bit more because you can't just run what you're doing off of your gut. And so this includes stuff like budgeting, business cases, custom analysis, priority service from us. So you can, again, kind of call Alan and me whenever you want to ask questions. And that starts at $300 a month, again, for those kind of smaller farms. It kind of goes up from there. We are also running a sale right now. So we're doing $200 off of onboarding or one-time cleanup. So with those monthly prices, I said, now that does not include the cost to like get everything cleaned up in the first place so that we can start doing this. So if you come to us and say like, hey, I would love help. I haven't done my books in 2 years. Can you please like get me caught up? We do charge for that. But this $200 off can be applied to that onboarding fee, or if you're doing a monthly service and you come to us and say, hey, my books are clean, I just don't want to do this anymore, like we can just apply that $200 to those monthly services. So this is for folks who sign up in January. So again, let us know if you want some help and we'll be happy to help. As far as other resources, we are not the only ones out there who help with this. So a lot of these accounting software systems will actually generate these kinds of reports we looked at for you. Some of them are very standard. It's like the balance sheet is just standard across all of them. Some of them, like you have to do a little bit more finagling to get the report set up, but you can generally generate all of this stuff in these softwares, and so they can be really helpful. There's lots of softwares out there for helping to track your sales. So I think Square is the one used most commonly, and we really like their integrations. But, Shopify has this, Gray's Cart, all these different things. So, but generally it's helpful to pick one. Makes it a lot easier if everything's in one place on the sales side. There's also a lot of farm management software out there that can really help with like, what's happening with all my enterprises, how much time am I spending on all this stuff? So FarmBright and Tend are 2 that we think work well, but there's a lot of good options out there. Like I said, we have Excel spreadsheet templates that kind of look like, all the examples we shared for anyone who wants a template. Veggie Compass is another one. So that's an extension resource. They also have really good templates for like different kinds of businesses. So they have like a vegetable one, row crops, they have livestock. So they have some really good things there. And then of course, you know, there's always outsourcing. You can hire us to do it for you. So we'd be happy to help. But of course, there's other like great bookkeepers and CPAs out there. So just find someone you trust. And then one last thing to tell you guys about, and then I promise I will stop talking except to answer questions, is we have one more webinar in this series next month, preparing for tax season. So we'll get into all those detailed tax questions for farmers. So you can scan the QR code there to sign up for that. All right. That was the end of my spiel. Is anyone else? And so I'll leave this on here for a few seconds, let people scan the QR code. And then I'm going to go to the next page, which has our contact info. So in case you guys have any questions for us, we'll leave that there for you. But yeah, did any other questions come through? Tackle at the end here.
No questions. Just Melissa said thank you.
All right. Yeah, we gotten some good questions early on. So yeah, hopefully we ran way over. So I'm sure people had to drop as well. I feel like we just need a budget an hour and a half for this. I feel like we always get really good questions and then it always goes long.
Next time we'll add in an extra 30 minutes. And Andy, to answer your question, the template will be shared with the recording, so that way you can download it.
All right. Well, if that's all, I guess we can let folks go. And of course, you guys have our contact info here. So if you think of anything after the webinar, feel free to reach out to us.